So we've done episode recently on finding deals, and today's episode, financing deals.
Yeah. Assembling capital,
yes.
capital stack.
What is the capital stack?
Well, before we get
Very
into that,
institutional.
Ray,
Yeah.
DJ Ray,
Got
Hit
it.
it.
hit it.
All right, let's go.
All
Let
right.
me just make a quick appeal to our listeners. Really appreciate everyone who's left a review on Apple Podcasts. It's what helps the podcast grow. We put a ton of time and effort into this. We genuinely don't make any money off this podcast. We do it for our fans. So all that being said, if you guys could jump on Apple Podcasts, leave a review, Google Podcasts, whatever you listen through.
I think you can comment on them now, right?
Yeah,
Can you add comments?
Subscribe to the YouTube
Oh,
channel.
yeah,
too.
definitely subscribe
That
to the
really
YouTube
helps
channel.
because we want to get the message out to other people, and the only way to grow the podcast is to defeat the algorithms and get these types of metrics. So please and thank you.
Yes, we appreciate it.
All right, yeah, good idea.
All right.
All right.
All right, so the
capital-
capital stack,
Yeah.
the stack of capital, like
Think
pancakes.
of it like a hamburger, like
Mm.
with different
Different
layers,
layers.
lettuce, cheese, a double patty.
I mean,
buns.
it'd be nice if you only had
You
to
had
have
a
one
graph.
patty
Mhm.
and it was all money because you just had unlimited capital.
Yeah,
but that's not the
If
real
your
world.
capital stack
Yeah.
consisted of your checkbook,
Yeah,
Yeah.
some people's.
right. Now, some people
Some
get
people's
started that
do.
way.
Yeah.
Most people do not.
Real estate is a capital intensive business. I've said it before, I'll say it again. So it's a challenging business to get into because it requires a lot of money.
Yeah.
So you assemble your capital stack. That's all the money, total development cost
Yes.
required to do a deal, from acquiring it to renovating it, paying attorneys, etc.
Right. So those are broken down into acquisition costs, your hard costs, which
So-
is the actual build costs, the soft costs, which are the costs that aren't the build but have to account for it, your interest reserves, and possibly an operating account as well for money that you have to spend before you get a draw from your lender, assuming you have a construction loan.
So interest payments.
and then your selling costs, broker fees, transfer taxes, all that. fun
Yep.
The nice thing about some of those costs, though, are like broker fees, particularly, are they're coming out the back end.
Yeah.
So
Back end on a for sale development won't necessarily be part of that stack, but they're to be considered when running your numbers and deciding whether it's a deal to pursue.
Correct.
Yeah. So, you're shopping for the biggest slice of this, sandwich stack is hopefully bank debt.
Yeah, your senior debt.
Yeah.
And this
Your
has been
traditional-
Whatever
challenged.
your least expensive costs
Yeah.
should be the bulk of your.
All right.
I will say that bank debt is relatively inexpensive.
Oh, of course.
Like it
even
is,
with today's rates.
yeah, even with today's rate, it is shockingly I
it
would
will
lend my
always
money
be.
at 8%.
Right. It will always be least expensive.
Yeah.
And depending on what you're doing with it, so if you're going to buy and hold the property, you are going to be paying less than somebody who's going to build and sell because that, in the bank's opinion, is riskier. And so it requires a higher return.
Yeah.
And when you're underwriting a deal and looking at the numbers, you just have to take that in consideration. But senior debt is where you want to lever up as much as you can,
Sure.
get as much money as you can out of that. But you're never going to get 100%. So
Well, let's stop at senior debt and just talk about, first of all, that's considered first position.
yes.
And that means that if everything goes wrong and someone's going to take back the asset, they get their money first.
Mm-hmm.
Yep.
So then who's in second position and third? We can talk more about that. But before we do, let's talk about how you evaluate alternatives when you're sourcing bank debt.
So in other words, if you
are
can't
going out
get
to
bank debt,
shop the rates. Rates is certainly one thing to look at, but there's others. So
like,
oh yes,
essentially,
I think- well,
loan
let's
covenants.
back
what you're
up.
saying.
off.
Maybe,
Like,
maybe
how
we can
much-
back up a little bit because I think the other specific things or terms that you want to look for is going to depend on the project itself. If it's a for sale development, you're going to look for certain, terms. But if it's a hold or a rental, there's going to be other specific terms. Like
Mhm.
with the rental side, you want to make sure that you're looking at prepayment penalties and things like that. But on a for sale development, there might be other things that you want to focus
Right.
on.
These are generally known as like the bank covenants. And so aside from like loan to value, what do you need to do in order to perform on the note, and for them not to call it and essentially start the foreclosure process.
Yeah.
So,
I'll throw an easy one out, which applies to both sometimes, both meaning a long-term buy hold versus a rehab, fix, flip, develop. And that's origination fee versus exit fee. So I will always favor an exit fee over an origination fee. Not that I like paying either, but I much prefer to give the bank their pound of flesh when the money's coming back in the door and when it's all going out at the beginning. So if I can negotiate a exit fee instead of an origination fee at the closing table at the outset, that's a small win.
have you had success with that?
Yes.
Okay. So you get the term sheet
as
part of the process. So let's further.
And this is obviously specifically on a for sale.
Yeah.
So you're
they don't charge those on rental buildings
in the form of a prepayment penalty,
on an exit fee
or an origin. Oh yeah, I guess I meant more of an origination.
Oh, origination.
We have
definitely.
origination, yeah.
But
We
you're not gonna negotiate an exit fee
That
on
would be
it.
nice. One day my
10
daughter
years.
will pay you. Yeah.
Yeah, actually, I think the deal that we're doing right now in Amesbury, we have a little bit of both. There was a fee, but they wanted half up front and half on the sales side. So
yeah,
but term sheet. So that's what you get when you're shopping the deal around, talking to somebody, a loan officer.
So I think step one, obviously, if we take a step back, so this is assuming that you've evaluated the deal, it's a good deal,
you've put it under contract.
Forward, you want to close on it, you want to buy it. The first step is you go out and you start shopping term sheets.
Now,
and that can mean talking
binding?
to somebody at your bank. Term sheets are generally not binding. No, it's like the offer letter when you're making an offer here in Massachusetts.
I've seen
things
people
can
get burned
change
on term sheets.
But term sheets, the first term sheet is not the term sheet. You can negotiate off of that. You will most likely have no luck trying to negotiate off of a commitment sheet, a commitment letter.
Yeah.
Now let's talk about now we can.
Well, that's where it gets binding. So take that step.
Well, no, I was going to say that when negotiating on a term sheet, things that we've had pretty good success on in the past is debt brokers. So, instead of you going to 10 different banks and shopping it around and saying, hey, here's all and you're talking with 10 different loan officers and dealing with that. You go to a debt broker and they'll put together a pitch deck for you based on the deal. And then they'll go out and shop it around based on their relationships. And we've had pretty good success at getting much better terms going through a debt broker than going direct to a lender.
Yeah, I'll go a step further and say we're exclusively debt broker relationship based. I don't. We've tried to give like repeat business, but sometimes the terms change. Sometimes where that individual is changes, and the new lender doesn't have the same flexibility as the prior lender. We used to have good relationships, and then it took one deal that went really sideways at the last minute that kind of almost screwed us on the closing, like 3 days before closing. And then after that, we, sort of reevaluated, asked others what they do. And that's where the debt broker came from. And, we've had very good luck with that. And if you think about it, I mean, they're sort of pre-vetting the deal as it is. Like their value add is they're going to pre-vet the deal and tell you what they think they can get you. And you can have that discussion during your due diligence period while you're under contract. And, if things don't look good, you can find a way out, right? So if it just looks like this is not going to be financed, or maybe they're not seeing the same comps that you saw, then you can have that discussion. But once you get past that first point, their value is like, now they're going to reach out to their network of lenders. They're going to say, we've already looked at the deal. We know the sponsors of the deal. They're good people. They get it done. You have to have experience. That's the other thing for senior debt. You're generally not going to get a bank to lend with you on your first deal.
Rodeo.
Yeah. There's so much risk. And we were naive enough to think that we could on our first deal, but we didn't.
Debt brokerage is expensive.
It is.
So you will
no.
pay, you will
one point
on bank debt.
Yes.
2 points on equity, which is say like, if they find you a private lender or a dentist who wants to bring money to your deal, they're going to charge 2 points on that.
We've never used a debt broker or I guess you call them an equity broker. We've never used a broker to source equity. Only
We've never had them complete that part of the stack.
Just
the debt side.
Yeah. So we're talking about different levers you can pull. You brought up debt brokers. I made the point they're kind of expensive. My other point is, I'll argue both sides quickly. One is that they're going to know banks that you don't know. I love to use the example Bank of the Ozarks, who came in very aggressively on a condominium deal in downtown Boston. We did. And we would never have met them had it not been for, I'll give them a shout out. Yeah. Brett Paulsrad over at JLL helped us meet those guys. The flip side, I think no one cares as much as you care about your own deal.
Yeah,
it's true. It's not an insult to anyone, but like whether that's your zoning attorney or your debt broker or whoever, like no one's going to beat the street, research the job and do more than you will.
Yeah.
But
listen,
you can.
It was a hard thing to see a $73,000 line item on our HUD when we closed in Lynn, right? Because that was 1% of the $7.3 million debt we got. However, looking where we're at today, that $73,000 would have been burned through during construction if we didn't have them. We'll give a shout out to, I guess, Coop and
Brian.
What's that?
Brian?
Yeah, Brian Coop over. Well, he was at Colliers. I forget where he's at now.
Yeah.
Long story short, without them, without that team in our corner, we would have burned through that money and more so, and been in a worse position. So I think
not only would we burn through money, we wouldn't have been able to lock our rate.
Well, that's what they did as part of the process, was they found us a lender that locked the rate during construction.
That's incredible.
And that was well worth the cost. So, yes, it's hard to see that number, but if you got to think would you have gotten that rate? Would you have gotten those terms? Would you have knocked down the fees here and there?
Well, look,
I think they have to add value, and they do.
Different banks are hungry for different deals at different times.
True. Right.
It is very true. Like East Boston Savings Bank was long on Boston Condo for a while. All of a sudden they flipped like a switch. I think they may have been bought, but it was like, oh, it's a condo deal in Boston. We got too much of that. We're not interested in Boston condo deal. But Bank of the Ozarks, like, we love that market. We don't have any money there. Please bring us condo deals here. So it's like very tough being a one-off. I do a deal every X years because I'm one person. Deals take a long time.
And it's also geographically specific as well. Like some lenders love the North Shore, some lenders love Boston, some lenders love the South Shore.
Too. They
change
monthly.
Like when we we used a debt broker for Amesbury because it's like we've never done a deal that far north before, and we found the broker found us a bank North Shore that loved the deal.
I will say that there are some guys out there who are like independent debt brokers, and they've sort of worked for some of those larger companies, and they maintain those relationships, and they offer that service for less than a point. And if you want to reach out, there's some guys I know who I recommend in that space.
Yeah, I mean, I would without a doubt, recommend a couple other places. And we Doug Landry with Land Up Capital, and we've worked with Brian Rooney at Finance Boston. So
Brian's a big listener.
Yeah, I mean, listen, I think they've helped us on all of these folks have helped us on all of these deals over the years. And so that's the other thing, is that there's also like the Colliers guys, when we were with them for Lynn, that was because it was a much larger deal, and they have different groups of banks that work on those size deals as well. I mean, when we were with Eagle Bank at the time, I think we had a couple $1 million with them, and we were like maxed out. And so then when banks max out, and this is a little technical, but when banks max out on your individual lending limits, they might participate with other banks, and it gets really complicated on the back end. I wouldn't want to be somebody dealing with all this, but the point is that these guys are specialists, and just like you have a flooring guy and a tile guy, Dan and I realize like we need a finance person that is going to be in our corner and help us out. And maybe it's not the same person every time, but we're giving the same 2 or 3 people a call every deal.
Cool.
Yeah.
All right. So now we've talked. Okay. I think we've beaten that.
Yeah. Well, let's go to the next step. Second tier, second position.
Or like the equity piece.
This is generally your own equity usually. But if it's a larger deal, you may have this general partner, limited partner split, right? Or even have mezzanine debt. So I've never done mezzanine debt. I don't know if you've
smart enough to talk through mezz debt versus pref debt.
We should have talked to when Ricky was on the pod. We should have talked to him about it.
Preferred equity versus mezz debt.
Yeah, I mean, I'm assuming that the mezz debt will be next up in the stack because it's debt and it's not equity. So that's really what's going to happen. They're second position, but they're going to be more expensive by a handful of points, I'm guessing. Again, never dealt with it, but moving on to the equity side, right?
I can't add much. That's about my understanding level.
Listen,
that's why we have guys like Brian Rooney.
Yes, exactly. And so, the point is these are all different considerations that have to be accounted for in your abacus or spreadsheet, if you will, of underwriting the deal. Like knowing what you can bring to the table, and the bigger the deal, the more people are going to be participating. And so everything gets kind of sliced and diced a little bit more. Everybody gets a piece of the pie, a bigger pie, but more pieces, so to speak.
Let's go to private lenders next, because there's a lot.
Yeah.
I feel like I get a LinkedIn message every day from our new private lender.
Yeah.
Which is totally different. This is
calls,
essentially not
texts, emails.
This is not going the senior debt route. This is going, I mean, it is senior debt, but this is going the non-institutional, non-banking.
Yeah.
This is the more Wild West, like you're going to get your knees cut off if you don't pay.
I mean,
or they're just going to foreclose very quickly.
Yes, more like that. They'll take the property.
So, like, certainly Dave Grossman and Jake Grossman, shout out Grossman.
Yeah, they're not going to take your knees off. I don't want to imply that for them.
They've sponsored our podcast in the past. Sean Kelly Rand from RD Advisories is another close friend of the pod, and I invest in his fund. But the one thing I'll say about private lenders is that the relationship matters a lot. Like they have, if you read the terms with a private lender, like they'll take your firstborn, but they don't want to. Like if you keep an open dialogue, if you tell them something's up or you need a little more money, something legitimate went wrong that you couldn't foresee, like you don't want guys, we say loan to own. You don't want someone like that somehow like in your camp.
There are guys.
There are guys that are like that. And then as soon as you miss that first payment, they're going to call for your first child. But hopefully it's somebody you've done repeat business with, a relationship. They don't want to take over your project. They're there to make their money in an honest way.
Yeah.
But they can also put the screws in you. So
there's two groups of private lenders, and they have different strategies. There's the ones that just want to see you perform and succeed, and the other ones want the same, but they're not afraid to jump in, and maybe they look at that as like, it's hard to say, but I mean, it's probably true that, the less experienced folks, they're going to say, well, if they mess up, I'm just going to make sure I'm so conservative that I'm going to make a ton of money either way.
Also, unless you have a pile of cash to do your first project, unfortunately, I think using a private lender for your first few deals is probably what you're going to have to do before you have enough of a track record to go to a traditional bank.
You do need to show some success.
At least when we started, I mean, you had so much experience with your private, like your job and everything like that.
That was an outlier.
We had zero construction or developing experience. So, and it was also 2009. When 9, 10, 12, when it was really bad out there still. And so like no one was lending to you really unless you had a lot of experience.
Yeah. I mean, the way I got my start though was traditional bank debt, but it was because I was just buying my own house. Like I needed a place to live.
Well,
I had a nice income from a real job, and I was able to get like a Fannie Mae, Freddie Mac backed loan.
Yeah. Well, so I bought my first 3-family that I lived in with an FHA loan, a traditional FHA loan. But I'm saying like
it wasn't a spec deal.
Where are you going to get the money to renovate it? That's
I didn't really have to. There wasn't much I needed I think I spent $20,000 on renovations. But I'm saying like a gut renovated 3-family, you're not going to qualify for that right off the bat.
Your point's taken.
Yeah.
Yeah.
And then there's another way to finance it if neither of those work, but you've got a seller that has no mortgage and maybe they're willing to
more rare.
It's more rare, but it's possible. I mean, maybe they're willing to be the bank.
Yeah.
They'll say, okay, I'll sell it to you knowing that I can take it back if you miss a payment, and then I know your plan is to renovate and sell it, so it's not like I'm not going to get paid in a year or two. And that's again, most sellers aren't like that, but that was actually our first deal. So our first deal.
Financing.
Yeah. The seller. So the scenario was he had owned the house for a while. It was a triple decker. There was one of the tenants started a fire on like the first floor. It didn't destroy the house. It just kind of like got a room. So we fixed up the room. I think he got like insurance money and then just didn't want to deal with it. So
he gutted the building. The building was completely gutted.
Well, you know what it was? You're right. He had put a new roof on after they cut the hole in it.
Roof windows.
Windows, gutted, and he started to plumb it and put like a shower tub stall thing in, and like the order of operations was messed up.
But it was framing.
Like, yeah, it was like I think he reached a point where he was like, this might be too much for me. So he didn't know anything on it.
So he sold it to you guys who had no experience. Right?
Bingo.
Yeah.
But we had nothing going on in our lives, and we were hungry and young, So
interesting.
Rare, but possible.
I want to make another point on private lending. Because like you're hobbling together this capital stack, right? And you're trying to infill where you can. You can go to friends and family, and you can get little bits from your brother-in-law, your father-in-law, whoever else, and try to pull that together. Or at a very similar rate, I think you can probably go to a private lender, and just have it from one source and not have 15 different uncles and aunts calling you about the status of your project. And there's annoyances to that. I think my hot take here is that the difference is that like if something goes wrong, I do not, the private lenders, the good ones, also have like an attorney on speed dial, and their docs are it's their docs.
Yeah.
You're signing.
You're not negotiating the notes.
You're not offering your note or your contract. So I'm not saying that you're doing this to get in a position for anyone loses money, but if that scenario does happen, typically like a private lender's interest rates kick to like 27%, like the ball moves to their court very quickly. Whereas the hobbled together equity piece of a bunch of small pieces. Does that make sense?
It does.
I think that's generally like a good way to view those.
I think so. I think though also if you have an established track record and you've been doing this for a while and you have a good amount of investors in your kind of portfolio, I guess, you can typically almost always do better from a rate or a financing standpoint than a private lender.
Okay.
Yeah, I think there's a middle ground there.
Really? Because like I'm seeing private lenders lending at like 12%, 13%. I would think you'd have to pay a friend or family 13 to 15.
I mean, so maybe it's more so on the term side, so we can defer the interest, for example. Yeah, like we can defer things.
It's a succinct way of putting money.
Yeah, we can defer it until there's a termination event or a sales event.
It also depends on I think the type of project too. Like a lot of times, a speculative build will always demand a higher interest rate or worse terms than a rental play, because the rental play is less risky. There's you're
always going to get
getting
tenants.
Income. It's a stable asset. So I think you get better terms usually, even from a private or friends and family type investment on a rental play than a speculative build.
Yeah. I mean, so the terms are what I call like the levers that you can pull, like what are the different levers? And it's tough to line up, lenders side by side like you would a bunch of drywall quotes. Because
what's nice, again, going back, what's nice about a debt broker is when they go out, they'll get they'll maybe get like 6 term sheets or 7 term sheets. They'll put them all in a spreadsheet, nice for you. They'll have everything lined up, and that way they'll send it over to you and you can compare like apples to apples. Right. It kind of helps.
They're going to try to help translate that language, but it's still not a perfect. One doesn't translate to the next because your lender in Lynn may have had a higher interest rate, but was willing to lock it for 5 years. This guy's going to come in low, but he's only willing to hold it for 3 years.
Of course.
They want a personal guarantee. You don't need a personal guarantee. Like, how do you put dollars to all of these things?
Well, that was the real consideration we had for that specific deal was, what's the probability? Because for us, it was like the prepayment penalty versus the floating rate versus the fixed rate. And, one was offering a floating rate, but no prepayment penalty. The other one was offering a fixed rate with a prepayment penalty. And we thought, as time went on, of course, throughout this whole process of getting to that financing closure was, do we think that the trade-off is going to be there in, the 2 to 3 year time frame? And we just weren't sure. And it was a gamble, but it turned out to be the right gamble to fix it and live with a prepayment penalty. So now what that means is like you pay off the note, and typically they have like a step down. So just like you said, 2 points for somebody to originate a loan. This is 5, 4, 3, 2, 1. if you pay it off within the first 1, 2, 3, 4, 5 years. So
you can't,
now we're on year 4.
If you do not refinance through
With
the
them.
same
With them,
Yeah.
yeah.
And you know, on a Fannie Freddie traditional loan, that's like illegal.
They have a 10-year
like
one.
Thanks Elizabeth Warren thing, and maybe actually thank you, because you can't charge prepayment penalties on a traditional
on residential.
On a residential loan, yeah. But if you're talking about a HUD loan for multifamily investors, they have like a 10-year prepayment penalty, and I think you have to be locked in for 10 years, or there's a really steep penalty.
All right, so prepayment penalty is a good example of a lever. I think another one that's interesting to talk through is quick personal guarantees versus completion guarantees. So we all know what a PG is. You're on the hook. Your house is on the hook. I don't care what your LLC is. You're on the hook if you sign a personal guarantee. Completion guarantee is what it sounds like. Finish the building, get a certificate of occupancy. If you've jumped that hurdle, we will not come after your assets.
There you go. Kind of like so it's known, I think it's known as like recourse versus non-recourse debt. But what you're saying is that so recourse debt means they can come after you, and non-recourse means they can't. Well, but yours is almost like a conditional one here, where they can come after you until you get to completion.
But read the completion guarantee critically, because sometimes it's like complete the building and also sell 50% of it.
It's like, what? I thought it was just complete and sell everything.
Like, that's a run-on sentence now.
Pay us back 100%.
And it's non-negotiable.
So always read the fine print. But then the fun part there's a bad boy carve out. So sometimes they'll offer you a no personal guarantee, non-recourse. But if you are do something criminal.
Right. I mean, that's pretty standard for all of these, even like the recourse debt that we...
It's going to be a tough one.
Or non-recourse debt. Yeah.
I will not sign something with a bad boy carve out.
Right. Like, no, everything's above board here. Wire fraud.
Another one on there is loan to value.
Yes.
That's another.
So how much? Yeah, go for it.
How much a lender will basically lend you versus the value, the appraised value of the property. So 75% is pretty standard across them.
And for new construction,
as complete as is acquisition, like I'm thinking.
Well, again, it depends on the type of project.
Yeah, there's loan to value and loan to cost, and so loan to value has to do with like what's it worth at purchase, and after construction is complete. So especially if that's your plan is to develop it. Loan to cost is basically what is your total development cost, all the dollars in that we've already talked about, and what's the value of the building. And so your hard and soft costs can still be part of that equation. So, we've seen lenders come down on that. We've seen, anytime there's an event where the market is kind of shocked or stressed short term, you'll see some lenders come down to like 50% loan to cost or loan to value, sometimes both.
Like COVID, we saw that during COVID a lot.
A lot of uncertainty. They don't want to lend anything. They don't know which way it's going. They basically unofficially freeze lending. But we've seen now with the way the rate and environment has been is that loan to cost has been down to like maybe 60%. So you're not getting that. Even if your loan to value is 80%, you're going to be capped by loan to cost. Or another term is debt service coverage ratio, which is if it's a rental property, how much cash are you bringing in on an operational basis? So that's your gross rents minus your vacancy and any other operating expenses. What's left over of that? Divide it by the debt coverage ratio, and then that's the max that they can lend you at whatever the prevailing rates are.
Divided by what?
So keep it simple. We'll say they have a debt service coverage ratio of 1.0, which is not typical, but just to make the math simple. And let's say your property brings in $500,000 a year. You take $500,000, you divide it by 12. That's the max that your monthly mortgage payment could be. And so then it's just an equation of what rates are they offering and how much are they lending, and like at what point do you equal that dollar amount. And then that's your limit. So you could be good on loan to cost, you could be good on loan to value, but your debt service coverage ratio is what limits how much money they will give you at any given time. And so any one of those three is basically your ceiling, right? So you can have two that are really good and one that's lower, and then that's as much money as you're going to get out of the
DSCR is not, they don't typically look at DSCR in a spec build. right? Because you're selling it.
Yeah, spec builds, they're not going to care about that.
Well, I'll say this. I use Hingham Institution for Savings for almost all my projects. They will always evaluate your condo deal with both a long-term rental and a
because
condo
if you have
play.
if you can't sell it,
and the amount that they're going to loan you is usually in today's market governed by the latter evaluation, which is how does this thing look as a rental play? And it's a certain number of units where that it's triggered that secondary review. And I know this because I've paid for the appraisals. And you're like, oh, why do I have to also appraise it this way? And it's like a requirement. And I think it's any like lender that is backed by FDIC. Whatever I think they need.
So it's more check the box than anything else.
Ways.
Yeah, but there's no
flexibility.
But there's no way you're going to hit their DSCR requirements on a spec build. You'd have to resell units out for like $10,000 a month to recover your nut.
It's challenging.
I was going to say, how often have developers actually pivoted? Typically, you'd say, "Oh, I was going to build it for apartments." Oh, well, you know what? Turns out the market's good, and I'm going to do condos.
I think people go that way more than you're not going the other way.
Go to condos, yeah.
You're not going from I'm going to build this as condos and be like, I think I'm going to rent these now. That usually never happens because the numbers never usually work.
Although we have had that conversation, I forget who it was years ago. They were talking about how they're de-condoing a building and making it apartments. I think it was with Chicago, right? Yeah. I wonder if that's still happening.
Yeah.
I did it once. At scale, maybe if your basis is low enough, maybe it works.
Yeah.
But
I did it once, and it was because I had two projects going concurrently, and they were both very good projects, and it was going to be a very tough tax year. It's kind of a humble brag, but it was like, why don't I save this one as a long-term buy and hold? It was never contemplated as such. Did a cost segregation on it. I got a huge year one depreciation
to help offset the gains.
To offset the really good project I did over here, and that was like, my accountant was like, hats off to you. That was good. So
well, we've done it before to avoid short or ordinary income.
Yeah.
And so we would renovate it with the intent to condo it, but we would rent it for a year and then maybe like touch.
Yeah. If you hang on to it for a year after CO.
And then you're only paying long-term capital gains.
Yeah. That's a really interesting delineation, is when it becomes long-term capital gains versus short-term ordinary income. Like as a real estate professional,
it's intent, not duration.
Yeah. So it's tough. Like there are blessings of being a real estate professional, and there are curses as it relates to the tax code. If you're not a real estate professional and you've owned it for more than a year, even if you're just fumbling around trying to flip something, I think you have a better argument.
True. Fair.
Anyway,
let me ask you this: make your own underwriting models, buy your own underwriting models, or beg for underwriting models. Which way do you go? Like, when you did your first deal, do you remember how you, like, was it back to the napkin?
Back to the napkin. Friend helped me do it and review it. But generally speaking, build your own, even if it's just like you're making a Frankenstein of somebody else's. Because like, unless you built it, you just don't know how it functions and what makes it trip. It's like, I want to know what
you also don't know if like the formulas are like, if it's like calculating things correctly.
Yeah.
Like that's,
you feel it?
That's what you were saying. Yeah.
I mean, raise the spreadsheet, man.
Yeah.
So
freaking the sheets. Thank you for that gift, Dan.
Nope.
Got a little coffee mug here, Excel on it. Love it.
Secret Santa.
Yeah.
Well,
this is good.
Is another good one.
Anyone have any questions about finance a deal? Definitely hit us up in like the notes or the comments. And if there's anything else,
if you guys have episode ideas, things that you think we should talk about, would be interesting to hear more on. Please DM, reach out. Ray is very approachable and friendly.
There you go.
Thank you for listening, reviewing, rating, subscribing, and watching, and we'll catch you on the next one.